Your brain is wired to lose money in the stock market. Overconfidence, loss aversion, anchoring, and herd instinct systematically distort your decisions. Behavioral finance research shows retail investors consistently underperform. Here's the evidence and how to fight back. Start with a paradox: the people most likely to make investment mistakes are the ones most confident they won't. Overconfidence bias makes us overestimate our knowledge and ability to predict markets. Studies show that overconfident investors trade more frequently, and frequent trading lowers returns. The irony is that those who need the most help are the least likely to seek it. They remember their wins and forget their losses, reinforcing a false sense of skill. This is not just a personality flaw, it's a systematic cognitive error that affects all of us. Recognizing it is the first step to neutralizing it. Loss aversion is the tendency to feel losses more intensely than gains. Prospect theory, developed by Kahneman and Tversky, models this with a value function that is steeper for losses than for gains. The typical ratio is about 2 to 1, losing $1 hurts twice as much as gaining $1 feels good. This asymmetry leads investors to hold losing positions too long, hoping to break even, and to sell winning positions too early, fearing a reversal. The formula captures the psychological pain of losses relative to gains. Loss aversion has a direct cost. If losing $10,000 hurts twice as much as gaining $10,000 feels good, you need a $20,000 gain just to feel neutral. This imbalance makes you avoid necessary losses and take excessive risks to recover. The result: you hold on to losing stocks, hoping they bounce back, and you sell winners too soon, capping your gains. Over time, this behavior erodes returns. The solution is to set predetermined stop-loss levels and rebalance your portfolio on a schedule, not on emotion. By automating decisions, you bypass the emotional toll of loss aversion. Anchoring is the tendency to rely too heavily on the first piece of information you see. In investing, the price you paid for a stock becomes an anchor, even though it has no bearing on the company's intrinsic value. The formula for perceived value is simple: your judgment of a stock's worth is biased by the anchor price. For example, if you bought at $100, you might refuse to sell at $80 because you're anchored to $100, even if the company's fundamentals have deteriorated. This bias prevents rational decision-making. To counter it, focus on current fundamentals, not historical purchase prices. Compare two investors, one anchored to the purchase price, the other focused on fundamentals. The anchored investor sees a stock at $80, bought at $100, and refuses to sell, waiting for a rebound to $100. The rational investor evaluates the company's earnings, growth, and industry conditions, and decides whether $80 is a fair price. The anchored investor may hold a losing position indefinitely, while the rational investor cuts losses or adds to winners based on evidence. The difference is not intelligence but the ability to ignore irrelevant anchors and focus on what matters, the company's future cash flows. Herd instinct is a survival mechanism from our ancestors. When one person runs, everyone runs. In markets, this translates into buying when everyone is buying and selling when everyone is selling. This behavior amplifies bubbles and crashes. The evidence is stark: retail investors often buy at peaks and sell at troughs, while institutional investors, who are less prone to herd behavior, tend to outperform. The Fortune-cited research shows that stocks with high institutional ownership outperform by 3.5% annually, while retail-heavy stocks underperform by 6.8%. Your collective intuition is a contrarian indicator. This table summarizes the performance differential between high institutional ownership stocks and high retail ownership stocks. High institutional ownership, 3.5% annual outperformance. High retail ownership, minus 6.8% annual underperformance. The gap is over 10 percentage points per year. This is not a small edge, it's a massive difference that compounds over time. The data suggests that following the crowd, retail investors, is a losing strategy. Instead, consider what institutions are doing, but always do your own research. This bar chart visualizes the annual return difference. The blue bar shows high institutional ownership stocks returning plus 3.5%. The red bar shows high retail ownership stocks returning minus 6.8%. The gap is stark. Over a decade, this difference compounds to a significant wealth gap. The lesson: don't be the last one in and the first one out. Herd behavior is a reliable way to lose money. Instead, use market sentiment as a contrarian signal. When everyone is euphoric, be cautious. When everyone is fearful, look for opportunities. A simple contrarian strategy is to fade extreme sentiment. The formula: your expected return is higher when retail sentiment is low and lower when it's high. This is not a guarantee, but a statistical edge. To validate, you would track a sentiment index and compare subsequent returns. If the relationship holds, you have a tradable signal. If it doesn't, the strategy fails. The key is to be systematic, not emotional. This formula is a hypothesis based on the evidence that retail investors often get it wrong. Here are the 4 key biases and their impact. Overconfidence leads to overtrading, reducing returns. Loss aversion causes you to hold losers and sell winners, lowering portfolio performance. Anchoring makes you fixate on irrelevant price levels, distorting valuation. Herd instinct drives you to buy high and sell low, amplifying losses. Each bias has a countermeasure: track your decisions, set rules, focus on fundamentals, and go against the crowd when appropriate. Awareness is the first step to overcoming these mental traps. Your brain is not your friend in the market, it's your enemy, but you can outsmart it. Overconfidence, loss aversion, anchoring, and herd instinct are deeply wired, but they are not destiny. By recognizing these biases, you can build systems that override them, set rules, automate rebalancing, focus on fundamentals, and treat sentiment as a contrarian indicator. The evidence is clear: those who think independently and act systematically tend to outperform. So next time you feel the urge to buy because everyone is buying, or to sell because everyone is selling, pause. Ask yourself, am I reacting, or am I thinking? That moment of reflection is your best defense. Thanks for watching. Markets reward discipline, not certainty. If this analysis helped, like the video and subscribe to DeepQuant. Tell us in the comments which market idea we should test next. Evidence beats noise. Control risk before chasing returns.